Welcome back, everybody, to our finale. This is the third round in our capital gains series. So thank you all for sticking it out for the full menu here. If you have not seen the first two videos, I have included a link to each video in the description below. We are going to focus today on tax loss harvesting and the carry forward. Before we get into this fun and exciting topic, though, I would super appreciate, as always, to all of my loyal listeners and followers to hit the like button on the video. If you haven't done so, please subscribe to the channel for all of our notifications and updates and all that. It's funny using this mic. I kind of feel like an athlete after a game, doing like a post game conference or something. Hold on here. Let's grab one of these. All right, there's the full effect. Okay, let's let's get serious here. So, tax loss harvesting. What are we doing here? This is more of an ongoing strategy. It's not like a specific rule or a definition in asset allocation. It's something that we are constantly doing. It's really, in its essence, the harvesting aspect is really just monitoring your current positions in your portfolio, specifically the realized gains or losses that you have incurred in a given year. What we're going to do towards the end of the year, typically in November, December, is we're going to analyze all of the realized gains and losses we have and kind of match them up and just kind of get a gauge of where we're at level-wise. How much do we have in net gains or losses, or how close are we to break even? And then towards the end of the year, we're going to look at some positions typically that we are showing losses in and say, does it make sense to sell this stock or these positions? Realize some extra losses to possibly offset realized gains that we've already incurred. Because again, when you can offset the gains, you are essentially lowering the potential capital gain tax liability. And if you're close enough to break even, you could potentially get yourself to showing a net capital loss, which you'll see why that's important in just a quick second. But anyway, again, that's really it. It sounds super simple, but it does take some active management. Just making sure you're aware, talking to your CPA or, downloading some gain loss reports for your particular portfolio and towards the end of the year, so you can kind of see and give yourself a check and where you're at and what you might need to do to, again, try to mitigate some of those tax expenses. I just want to highlight the fact that you don't show a loss until you actually sell a position. I get a lot of questions about, holding periods when I put cash into an account and then withdraw the cash. That has nothing to do with anything related to holding periods. It is simply when you bought it and when you sold it. Once you sell it, that is the taxable event. You realize a gain or a loss. Okay, so let's say you're showing the loss. Now, the maximum that you can show in any given year is up to $3,000. You can show a maximum of $3,000. But one of the great things here is you can, if you do have that $3,000 capital loss, you can deduct that against your income. That is if you are filing jointly. If you're a single tax filer, you can deduct up to $1,500 of these capital losses. That's just the basics on the capital loss. But what happens if you have more than the $3,000 maximum? Well, that's where another cool piece of this comes in, and it is the carry forward. As you'll see here, so the carry forward is simply when you have an excess of the maximum, you are allowed to carry it forward and bring it into the following tax year. I'm going to do a couple examples. Let's do a very easy basic example at first here just to show how it works. So in 2019, you had a $6,000 net capital loss. As we just saw, you can take $3,000 of that and deduct it from your income. Now, thanks to our friend, the carry forward, you bring the balance of $3,000 into the year 2020. Now, let's say in 2020, for this easy example, you don't do any trades, so you have no realized gains or losses, but you still have your $3,000 carry forward in the back pocket. Well, that essentially allows you to show that as a $3,000 net capital loss in 2020 and thus deduct that against your 2020's income. That's an easy example, but you can see the powerful piece of this puzzle if you are allowed to do so. Now let's get a little tricky on the math side before we close up here. So let's say you have a $10,000 net capital loss in 2019. Well, as we are well versed in now, we know you can take $3,000 of that and deduct it from your 2019 income. And now you're going to take the balance of $7,000 and bring that into the year 2020. Now let's say you have $2,000 in net capital gains for 2020, but you got that $7,000 carry forward loss in your back pocket, so you offset the $2,000 gain, and you now have a net capital loss of $5,000. Well, we are just recycling the idea here, and we're taking our maximum of $3,000 in our capital loss for 2020. We're going to deduct that from our income, and now we're going to take the balance and bring it into 2021. So now we have the balance of $2,000 as a capital loss, bringing it into 2021, and we will see what happens in that year. But hopefully you can kind of follow the path and see how it goes. One last thing here, the IRS throws us one more bone when it comes to trading and tax efficiency. That is specifying tax lots. What do I mean by that? Well, this is really when you are buying the same stock on multiple different occasions. So when you buy it, each occasion you buy it, you have what's called a specific tax lot and a cost basis related to that tax lot. You can see here in this example, I'm just trying to make it easy on the 100 share lots, but you're buying the stock at 3 different occasions, at 30, at 50, and at 70, 100 shares each time. But again, each one of those purchases comes with its own cost basis just by doing the math of your shares multiplied by the dollar price of the stock. And now let's say after a few years, you've done a few purchases, and now the stock has gone up to $100. That's awesome. You know, you want to take some money off the table, but you want to keep some skin in the game. So you say, all right, I want to sell 100 shares of my 300 share total. Well, the IRS allows you can go in when you put in your sell order to your online broker, you can specify which 100 share lot that you want to sell. Now, typically, if it was a taxable account and assuming that the gains were either all short-term or all long-term, similar profile, you would want to specify the most highest cost share lot that you have. Why is that? Well, it's really simple math. You've got a $70 cost basis and a $100 sales price. So your gain there is $30 a share. 100 minus 70 times the 100 shares, that's $3,000. That's if you sold that last lot with the $70 cost basis. Just as a comparative example, let's say you didn't do any instructions and you just sold your first in, first out 100 share lot. That would have been your first purchase at $30 a share. Now do the quick math here, folks. So you got $30 a share and you sold it at 100. That's a $70 gain on 100 shares. $7,000 capital gain. Again, whereas in the previous one that I just showed you, you only had a $3,000 capital gain. That's real money. I mean, just slap a 20% long-term capital gain rate on both of those, and you've got what? You've got $1,400 versus $600 as the example. Sorry if I'm getting a little lost here in the math, but you can clearly see, I mean, this makes a big difference. So it's important to know. That is going to conclude our series. Hopefully ended on a high note there, saving some money in taxes. Can't ever go wrong there. If you have any questions on the topic or topics discussed either here or in any of the previous videos, please feel free to send us an email. Thank you all. I hope everyone has a happy and healthy Memorial Day weekend as we ring in summer 2021. We will see you all on the next video.